Welcome back to Black Cat Crypto Club, everybody. My name is Drake, and I kind of screwed up. I wanted to do this live streamed so you guys would be able to get this as it was happening. Unfortunately, I didn't know that apparently with YouTube, you have to request to live stream 24 hours in advance. So being it my first thing, I didn't get that done. And so I'm going to be recording this live, but I wasn't able to stream it to you guys. So hopefully you guys can get this as soon as possible. It's not dire news or anything. It's just the Federal Reserve meeting, but what are we going to be expecting from this is the question. There's not going to be any change in interest rates today. The Fed's more than likely going to keep rates the same. So what does that mean? What does that mean for Bitcoin and cryptocurrency? Well, it's kind of funny because either way, Bitcoin kind of wins, right? So interest rate wise, what we look for is with inflation, the Fed has said that they're committed to bringing inflation down to 2%. So when inflation gets higher, the Federal Reserve usually tightens their stance and increases rates. And so that's what we saw in 2022. Inflation got up to like 9%. And so the Fed has constantly increased throughout 2022. They've increased the interest rates. And what that does is it puts pressure on the economy, makes it so there's not as much cheap money flowing into the markets, and it brings down inflation. There's not as much money printing going on. So inflation comes down over time when rates are high. And when we see inflation come down, that's when the Federal Reserve finds it safe to lower rates. So when the Fed lower rates, there's more money coming into the market. It's cheaper to get money, cheaper to get loans. And so there's a lot more money floating around. And it generally, people have more money to do things with, which includes investing in the stock market or investing into Bitcoin. And so when rates are low, when rates are lowered, Bitcoin tends to go up. But also, when inflation gets out of control, your purchasing power of your dollar goes down. So all Bitcoin has to do really is just stay the same. And it looks good against the dollar. It increases against the dollar, even though Bitcoin is just staying the same. Now, Bitcoin doesn't stay the same. Since it's come into existence, we've constantly seen more and more and more adoption all the time. At where we're at right now, Bitcoin isn't really widely adopted at all yet. We just opened up this market into Wall Street with these new ETFs, but institutions and big money really still haven't come into the space. They kind of have a way now, but even the biggest institutions can't buy right now because the wirehouses aren't turned on for them to buy yet. So as far as adoption, we're always increasing, which actually helps Bitcoin, but we also have the dollar inflating. So the purchasing power of the dollar goes down and Bitcoin just looks magnificent against it because the adoption's going up, the dollar's going down, and it just outperforms everything else we've ever seen. So either way, inflation goes up, Bitcoin wins. Inflation goes down, more money comes into the market, eventually leading to more inflation. It's kind of a weird, crazy cyclical cycle, but we're really in kind of this weird period where, I mean, our money system in the US just isn't sustainable, right? And ever since about 2012, it really hasn't been sustainable at all. You know, the Fed is constantly juggling where they can get inflation to, but they also can't crash the economy. So I was actually listening to Mark Yusko talking yesterday, and he brought up some valid points. You know, he said, you know, we've kind of been spoiled with these 0% rates over the last little while. You know, we had in 2012, we kind of went down to these low rates, and it's kind of fluctuated a little bit, but we feel kind of entitled that interest rates need to go back down to zero. And he was saying that's not really the case. That's been something that's been really recent, these low interest rates. And that is a valid point. However, I think where we are, it's so hard. The Fed, like I said, is walking this tightrope that is just unsustainable. And the economy right now is, it depends on where you look and who you ask, right? So we've got these baby boomers that are now retiring, living on Social Security, and they've had their entire life to gain assets. So they have stocks, bonds, they own their homes, and they're retired and they're living off Social Security. So for them, the economy's great, you know, like they're living it. They're, you know, toasting, having nice dinners and toasting wine, and things are good. But for the younger generation, I mean, they can't even pay rent right now. So it depends on where you look. The economy is either, you know, great if you're looking in one demographic, and it's a dumpster fire for others. So the Fed, they've been lucky so far. You know, the economy has seemed to be strong, but I don't know. I don't see them personally. I don't see them keeping rates up. And Jerome Powell himself has said several times that they look to cut rates this year. They're not going to do it today, but it'll be interesting to see what he says in this interview. If he comes out hawkish, meaning very against cutting rates in the future, or whether his verbiage kind of takes a dovish approach where it really kind of signals that they're at the end of rate hikes and they're looking towards rate cuts soon. So that's the kind of thing we're going to look for. I've got that pulled up, so when he comes out to do his speech, we'll be able to watch him and listen to him. And I've got TradeView up as well, so we'll be able to watch kind of how the market kind of reacts to what he's saying. But yeah, I mean, it's interesting because the market does what markets do, and speculative money is kind of like this butterfly, and it's flipping around from here and there, and it gets blown at every single little wind that comes along. You know, any little bit of news and the market just flitters around and does this little dance. But when talking about Bitcoin's market, especially, like Bitcoin's market can flitter on people just moving their money to Coinbase or an exchange. That will affect the market. If big money does that, people just freak out and it affects the market. But once the dust settles, Bitcoin kind of wins either way in this. You know, inflation goes up, it's good. Inflation goes down, more money comes into the market, goes into Bitcoin, it's good. Either way, Bitcoin wins. It'll have its ups and downs, but either way is good. So yeah, it looks like they're getting ready. So I'm going to come over here. Looks like he might be coming out. So yeah, you can see we're actually doing pretty well today. We're up here. We're now at 64.2, which we dropped last night, or this was this morning, but last night we were clear down to, I mean, we were below 61,000. We hit down to 60,800. So yeah, we've come up this morning. So here's Powell. Let's get over to him.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. The economy has made considerable progress toward our dual mandate objectives. Inflation has eased substantially, while the labor market has remained strong. And that is very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.2%. For 2023 as a whole, GDP expanded 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have weighed on business fixed investment. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2% over the next 2 years. Participants generally revised up their growth projections since December, reflecting the strength of incoming data, including data on labor supply. The labor market remains relatively tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 265,000 jobs per month. The unemployment rate has edged up but remains low at 3.9%. Strong job creation has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a continued strong pace of immigration. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressure on inflation. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.1% at the end of next year. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as from measures from financial markets. The median projection in the SEP for total PCE inflation falls to 2.4% this year, 2.2% next year, and 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are coming into better balance. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably down toward 2%. Of course, we're committed to both sides of our dual mandate, and an unexpected weakening in the labor market could also warrant a policy response. We will continue to make our decisions meeting by meeting. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of this year, 3.9% at the end of 2025, and 3.1% at the end of 2026, still above the median longer-term funds rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. Turning to our balance sheet, our securities holdings have declined by nearly $1.5 trillion since the committee began reducing our portfolio. At this meeting, we discussed issues related to slowing the pace of decline in our securities holdings. While we did not make any decisions today on this, the general sense of the committee is that it will be appropriate to slow the pace of runoff fairly soon, consistent with the plans we previously issued. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach that ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping our longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and price stability over the long term. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you. Microphone.
So hopefully
Steve Leisman,
somebody
CNBC.
asks
Mr.
him
Chairman,
about the banking system.
the
Last time they
projections
completely
show
dropped that ball, but
somewhat
let's
higher
watch.
core inflation. They also show somewhat stronger growth. What should we infer from this notion that on average, rates were kept the same this year, but inflation is higher and growth is higher? Does it mean more tolerance for higher inflation and less of a willingness to slow the economy to achieve that target?
Well, it doesn't. No, it doesn't mean that. What it means is that we've seen incoming, as I pointed out in my opening remarks, we did mark up our growth forecast, and so have many other forecasters. So the economy is performing well. And the inflation data came in a little bit higher as a separate matter, and I think that caused people to write up their inflation. But nonetheless, we continue to make good progress on bringing inflation down. And so...
When you, just to follow up, when you say that you're willing to either maintain the rate for longer, what is the tolerance of the Federal Reserve for inflation coming in above its 2% target?
So we're strongly committed to bringing inflation down to 2% over time. That is our goal, and we will achieve that goal. Markets believe we will achieve that goal, and they should believe that, because that's what will happen over time. But we stress over time, and so I think we're making projections that do show that happening, and we're committed to that outcome, and we will bring it about.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You and others have been saying that relief on housing inflation is coming, but it still hasn't shown up meaningfully in the CPI or the PCE. Does that challenge your assumption about when the shift will finally break through, since it hasn't at that point?
So I think there's some confidence that the market rents, lower market rent increases that we're seeing will show up in measures of housing services inflation over time. There's a little bit of uncertainty about when that will happen, but there's real confidence that they will show up eventually over time. But again, uncertainty about the exact timing of that.
Okay. And will you be able to get overall inflation down to target if housing doesn't break through quickly, and does that affect the timing for eventual cuts this year?
We will get aggregate inflation down to 2% over time. We will. And I would assume that what we'll continue to see is we'll see goods prices coming into a new equilibrium where they're going down perhaps not as quickly as they had been earlier this year, where housing services inflation will come back down as current market rents are suggesting will happen, and where non-housing services will move back down. Some combination of those three things, and it may be different from the combination we had before the pandemic, will be achieved and will bring inflation back down to 2% sustainably.
Nick Timmeros of the Wall Street Journal. Chair Powell, during your congressional testimony this month, you said that your test for making the first change to interest rates does not require you to be terribly comfortable that inflation is at 2% because interest rates are well above neutral. At the same time, you said here after the last meeting that the first cut is highly consequential. Can you reconcile these views for me? If rates are well above neutral, why would the first cut be highly consequential? Is that because you anticipate one cut would be followed by one or two more along the lines of the recalibration you made in 2019, which itself was modeled on the mid-cycle adjustment of 1995?
It's more, I would put it more in the context of what I said in my opening remarks, that the risks are really two-sided here. We're in a situation where, if we ease too much or too soon, we could see inflation come back, and if we ease too late, we could do unnecessary harm to employment and people's working lives. And so we do see the risks as two-sided. So it is consequential. We want to be careful. And fortunately, with the economy growing, with the labor market strong, and with inflation coming down, we can approach that question carefully and let the data speak on that. That's really what I was thinking.
How much of that inflation that we've seen so far this year do you chalk up to one-off calendar adjustment effects following a period of high inflation versus some change in the trend we saw in the second half of last year?
So I want to start by saying I always try to be careful about dismissing data that we don't like. So you need to check yourself on that, and I'll do that. But I would say the January number, which was very high, the January CPI and PCE numbers were quite high. There's reason to think that there could be seasonal effects there. But nonetheless, we don't want to be completely dismissive of it. The February number was higher than expectations, but we have it at currently well below 30 basis points core PCE, which is not terribly high. So it's not like the January number. But I take the two of them together, and I think they haven't really changed the overall story, which is that of inflation moving down gradually on a sometimes bumpy road toward 2%. I don't think that story has changed. I also don't think that those readings added to anyone's confidence that we're moving closer to that point. But we didn't. Last thing I'll say is we didn't excessively celebrate the good inflation readings we got in the last 7 months of last year. We didn't take too much signal out of that. What you heard us saying was that we needed to see more, that we could, we wanted to be careful about that decision. And we're not going to overreact as well to these 2 months of data, nor are we going to ignore them.
Man, that was wild. Powell is
hi, yes, Chair Powell.
Gangsta. He just told that guy to check
could you
himself
speak a little
before he
bit more
wrecks
about
himself.
the timing? Is there enough data between now and, say, May to be able to get the kind of confidence that you say that you still need? Or by June, is there enough data for you? Just give us a sense of your thinking there. Thank you.
Yeah, so we make decisions meeting by meeting, and we didn't make any decisions about future meetings today. Those are going to depend on our ongoing assessment of the incoming data, the evolving outlook, and the balance of risk. So I really don't have anything for you on any specific meeting looking forward.
But, just a question of, is there even enough data for you to be able to?
We'll take,
sorry.
Things can happen during an intermeeting period, if you look back, unexpected things. So I wouldn't want to dismiss anything. So I just would say that the committee wants to see more data that gives us higher confidence that inflation is moving down sustainably toward 2%. I also mentioned, and we don't see this in the data right now, but if there were a significant weakening in the data, particularly in the labor market, that could also be a reason for us to begin the process of reducing rates. Again, there's nothing in the data pointing at that, but those are the things that we'll be looking at coming meetings, and without trying to refer to any specific meeting.
Chris.
Hi, Chris Regaber, Associated Press. Thank you. In the projections, there is an increase in the neutral rate, as you know, and higher rates, a quarter point higher rates projected in 2025, 2026. Can you speak about what might be behind that? Is there a real sense here that the economy has perhaps changed in some way, that higher rates will be needed in the future? Thank you.
So you're right, they're pretty modest changes, but you're right, there was an uptick in the longer run rate, and also there's a 25 basis point increase in 25 and 26. In terms of are rates going to be higher in the longer run, if that's really your question, I don't think we know that. I think we think that rates were generally low during the pre-pandemic, post-global financial crisis era for reasons that are mostly, important, slow-moving, large things like demographics and productivity and that sort of thing, things that don't move quickly. But I don't think we know. My instinct would be that rates will not go back down to the very low levels that we saw, where all around the world there were long-run rates that were at or below zero in some cases. I don't see rates going back down to that level, but I think there's tremendous uncertainty around that.
Great. And just a quick follow on the projections, you also have 2.6% core inflation for the end of this year. It's already at, or you mentioned it being 2.8 in February. That doesn't sound like much disinflation at all. So are you still confident, or the last press conference you sounded pretty optimistic you would get more confidence to the end of this year. Is it right to say that this suggests you're not seeing a lot of disinflation this year compared to what we've seen 2023 and so forth? I
think that higher year-end number reflects the data we've seen so far this year, because you're now in this year. So I think that. Sorry, say your last part of your question again.
Well,
Are you still optimistic that you'll get the confidence you need this year?
I think if you look at the SEP, what it says is that it is still likely in most people's view that we will achieve that confidence and that there will be rate cuts. But that's really going to depend on the incoming data. It is. The other thing is, in the second half of the year, you have some pretty low readings, so it might be harder to make progress as you move that 12-month window forward. Nonetheless, we're looking for data that confirm the kind of low readings that we had last year and give us a higher degree of confidence that what we saw was really inflation moving sustainably down to 2%, toward 2%.
Toward 2%. He's kind of softening his stance there.
It would be a reason to potentially cut rates, or at least a consideration in making a rate cut. Would continued strength in the labor market be a reason to hold off on rate cuts? And just in general, if labor supply continued to rebound in 2024 the way it did in 2023, what would stronger hiring and possibly stronger growth mean for the path forward on policy?
Yeah, so if what we're getting is a lot of supply and a lot of demand, and that supply is actually feeding demand because workers are getting paid and they're spending, and that's, what you would have is potentially kind of what you had last year, which is a bigger economy where inflationary pressures are not increasing. In fact, they were decreasing. So you can have that if you have the continued supply side activity that we had last year, with both with supply chains and also with growth in the size of the labor force.
But so strong hiring in and of itself would not be a reason to hold off on rate cuts?
No, not all by itself, no. I mean, you saw last year very strong hiring and inflation coming down quickly. We now have a better sense that a big part of that was supply side healing, particularly with growth in the labor force. So in and of itself, strong job growth is not a reason, for us to be concerned about inflation.
Neil. Hi, Chair Powell. Neil Irwin with Axios. How do you assess the state of financial conditions right now, and in particular, do you view the kind of easing in financial conditions since the fall as consistent and compatible with what you're trying to achieve on the inflation mandate?
So we think there are many different financial conditions indicators, and you can kind of, see different answers to that question. But ultimately, we do think that financial conditions are weighing on economic activity, and we think you see that in a great place to see it is in the labor market, where you've seen demand cooling off a little bit from the extremely high levels. And there I would point to job openings, quits, surveys, the hiring rate, things like that are really demand. There are also supply side things happening, but I think those are demand side things happening. We saw, that's been a question for a while. We did see progress on inflation last year, significant progress, despite, financial conditions sometimes being tighter, sometimes looser.
Michael McGee with Bloomberg Radio and Television. Can you give us more color on how the committee is thinking about inflation dynamics now? What we've seen at the beginning of the year, are they more one-off increases that will fade, or is there more of a secular turn with goods prices rising again and service prices staying sticky? And also, housing prices have been sort of the Godot of this cycle, in that you keep expecting them to go down and they don't. How does the committee see this playing out forward since you've raised your inflation forecast?
So I see the committees looking at the 2 months of data and asking the same question you're asking and saying we're just going to have to see what the data show. As I mentioned, you can look at January, which is very high reading, and I think many people did see the possibility of seasonal adjustment problems there. But again, you got to be careful about dismissing the parts of the data that you don't like. So then February wasn't as high, but it was higher. So the question is, what are we going to see? We tend to see a little bit stronger, this is in the data, a little bit stronger inflation in the first half of the year, a little bit less strong later in the year. We're going to let the data show. I don't think we really know whether this is a bump on the road or something more. We'll have to find out. In the meantime, the economy is strong, the labor market is strong, inflation has come way down, and that gives us the ability to approach this question carefully and feel more confident that inflation is moving down sustainably at 2% when we take that step to begin dialing back our restrictive policy.
Well, you've talked about the desire to have confidence that inflation is continually moving down. Has the recent numbers we've gotten for inflation data dented that confidence at all?
It certainly hasn't improved our confidence. It hasn't raised anyone's confidence, but I would say that the story is really essentially the same, and that is of inflation coming down gradually toward 2% on a sometimes bumpy path, as I mentioned. I think that's what you still see. We've got 9 months of 2.5% inflation now. And we've had 2 months of kind of bumpy inflation. We were saying that it's going to be a bumpy ride. We consistently said that. Now here are some bumps, and the question is, are they more than bumps? And we can't know that. That's why we are approaching this question carefully. It is very important for everyone that we serve that we do get inflation sustainably down. And I think the historical record, every situation is different, but the historical record is that you need to approach that question carefully and try to get it right the first time and not have to come back and raise rates again, perhaps, if you cut inappropriately.
Okay, so I'm going to mute him there for now. What he just said is interesting because that comes off as very dovish to me. He basically said that this PPI inflation's number that we got last week isn't concerning to him. It went up in respect to everybody's kind of forecast, but he doesn't see that as being a problem. So honestly, that's hugely dovish. Plus, we kind of heard him say there, we're working to bring inflation down to 2%, which is, he said, we're working to bring it down to 2% or towards 2%. So he's kind of softening up there, I think, in his words. But it was interesting, he basically just said, don't freak out about these last inflation numbers that everybody's freaking out about. And, now we're actually seeing the markets. This is a good sign that the markets are kind of seeing that same thing is everything he's saying is kind of on the dovish side. He's said that he still sees rate cuts this year. And so that's interesting. Hopefully now we can get past this. Ever since it was Thursday, we hit that PPI inflation data, and that has just kind of caused this whole thing down here. Hopefully now we're seeing that breakout up here above. So I guess we'll see. Hopefully this was just like market jitters over this FOMC meeting, but you never know. The thing is, guys, is news, Bitcoin and cryptocurrency news continues to be very bearish. I woke up and saw all the headlines in the crypto news, and it was all saying the dip is not over, the dip is not over. And it's just funny. News will always try to get your attention, it's always in for the clicks, So I don't know. It'll be interesting. Especially it'll be interesting if we can get above that kind of line with this bounce that we're seeing. Then we've broke that trend line and we'll probably see a recovery. But I was going to also bring up another point. So guys, we have two types of people when it comes to buying. And the first type is, you know, we're going along in this price action, and then all of a sudden we get a bump to like right here, right in here. And one person at this point, you know, says, whoa, we just had this massive increase in Bitcoin. It's too expensive. I'm not buying. And so they miss out on this whole way up. And, you know, they say it's too expensive. We're not going to buy until it dips. So it comes up, it comes up, it comes up. And then we have this dip that doesn't reach this point that they were possibly thinking about it. And they said it was too expensive. But this dip gives them, this is very healthy, because this gives those people a chance to rationally buy a dip, even though it's more expensive than what they said was too expensive. This gives them an opportunity to buy the dip that they were looking for. So something like this is actually really healthy, because it gives people a chance to think, yes, this is the time to buy. Now, there's another type of person that said, you know, it's too expensive right here, I'm not going to buy. And it goes up and it goes up and it goes up. And it's too expensive to buy here too, so we're not going to buy there. And then we go into this dip, and that same person that said it was too high here, it was too high here, once we get down into this dip, they've got an opportunity, but they look at this past week and they go, man, Bitcoin's not doing good. I'm going to continue to not buy. And it's that kind of psychology that just kind of screws people every time. They're constantly making one excuse or the other, and it'll never work out for you. And if you know, guys, the halving is coming up. Sorry, that line doesn't make sense, but the halving's coming up. So it doesn't matter where you buy, really. At the end of the day, we've got this major catalyst coming, and it's insane not to buy. But anyways, let's get back into this question.
Fairly soon, does that mean that the committee would meet about this again in May, and a decision could be reached that soon? And I was wondering if you could also just describe the scope of what the committee is discussing here. You're at $95 billion of caps right now. Would that be cut about in half or something in that nature? Thank you.
So that is what we're discussing, essentially, is and we're not discussing all the many other balance sheet issues. We will discuss those in due course, but what we're really looking at is slowing the pace of runoff. There isn't much runoff among MBS right now, but there is in treasuries, and we're talking about going to a lower pace. I don't want to give you a specific number because we haven't had an agreement or a decision, but that's the idea, that's what we're looking at. And in terms of the timing, I said fairly soon. I wouldn't want to try to be more specific than that, but you get the idea. The idea is, and this is in our longer run plans, that we may actually be able to get to a lower level because we would avoid the kind of frictions that can happen. Liquidity is not evenly distributed in the system, and there can be times when, in the aggregate, reserves are ample or even abundant, but not in every part. And those parts where they're not ample, there can be stress. And that can cause you to prematurely stop the process to avoid the stress. And then it would be very hard to restart, we think. So as something like that happened in 19, perhaps. So that's what we're doing. We're looking at what would be a good time and what would be a good structure. And, fairly soon is words that we use to mean fairly soon.
And will there be a discussion about returning to an all treasuries balance sheet at some point?
So that our longer run goal is to return to a balance sheet that is mostly treasuries. I do expect that once we're through this, we'll come back to the other issues about the composition and the maturity and revisit those issues. But it's, not urgent right now. We want to get this this decision made first, and then we can, when the time is right, come back to the other issues.
Victoria. Hi, Victoria Guido with Politico. Also on the balance sheet, can you talk a little bit about how the outlook for the banking sector might impact your balance sheet plans? Do you worry that as deposits start to shrink that we could see more turbulence?
We'll be watching carefully, but one of the reasons we're slowing down, we will soon enough, fairly soon, I should say, slow down, is that we want to avoid any kind of turbulence. I wasn't thinking particularly about banking sector turbulence, but we had some indicators the last time. This is our second time in doing this, and I think we're going to be paying a lot of attention to the things that started to happen and that foreshadowed what eventually happened at the end of that tightening cycle, where we wound up in a short reserve situation, and we don't want to do that again. And I think now we have a better sense of what are the indicators. It wasn't so much in the banking system as it was around, for example, where federal funds is trading relative to the administered rates, and where secured rates are relative to the administered rates, those sorts of things. We will always be watching the banking system for similar signs, though.
Well, is it also because you're not sure exactly how the reserve supply will react once the overnight reverse repo facility, drops nearer at zero?
I think we broadly think that once the overnight repo stabilizes either at zero or close to zero, that as the balance sheet shrinks, we should expect that reserves will decline pretty close to dollar for dollar with that. That's what we think.
Let's go to Jean. Hi, Chair Powell. Jean Young with M&I Market News.
Okay, guys, we're gonna cut it there. So that was the question I was kind of hoping would be addressed. He was asked about the banking system, and really, Jerome Powell, you gotta love him because he's so calm, and he just brings that sense of calmness, and he's logical and level-headed. And he just kind of exudes this calming effect, which is probably why he's chair. But I mean, you didn't get that with Alan Greenspan and some of these other chairs, but he has constantly said, we're here to, our dual mandate is to bring inflation down, and basically the other mandate is to protect the economy, protect the labor force. And so we see him sticking to that here, but his prime directive, guys, he's the chair for a central bank, the U.S. central bank, the Federal Reserve. So his prime directive, and he'll never say this, but the prime directive for him is to instill confidence in the banking system, in the economic banking system of the United States. If banks start failing and banks start, the public starts not trusting banks, we'll quickly see him move to change things. So that was really the question I was kind of hoping. It could have been a little more direct and hard for him. They could have addressed the banks that are failing right now, New York Community Bank and these other ones. But it's interesting because he basically said, we're watching that like a hawk. And if banks start failing like they did, like he said, at the end of the tightening cycle last year, they're going to be forced. It doesn't matter if inflation is back down to 2% or not. They're going to have to cut rates and stimulate that at least the banking sector. So that's the real question. And a lot of people say, maybe 3% is the new 2% now. We're in this unsustainable monetary system, and maybe there just isn't a way to get back down to 2% without the banks failing, without the economy failing. And so some people are thinking, what is he going to do if things start crashing and we still aren't back down to that 2%? Well, ultimately, it goes back to that prime directive of him keeping confidence in the banking system. That's what's going to happen. The inflation will take a back seat to that if it comes to it. So I don't know. It's interesting to watch. I think the markets were well up on Bitcoin's price since the FOMC, this speech began. So hopefully the market is through with their little jittery, thing with this whole thing, and we get back to business. But like I said, this dip has been nothing but healthy. Yeah, this is actually great because it gives money the chance to come in that was just waiting for that chance. So really, when we see these dips, it's not fun, guys. It's watching your value drop from day to day is not fun, but in these massive up cycles, it's just a necessary thing, because without it, we'd shoot up too fast, and then we'd have this serious overcorrection, which is kind of what happens with the halving anyway. We see this massive thing up after the halving, and then it's an overreaction, and then things overcorrect to the downside. That's why we see 80% downturns on that fourth year of the cycle. So I don't know, going back, it's this latest dip was like 15 or so percent. Totally healthy for the market. A lot of people get scared, and Bitcoin changes, price moves a lot more in Bitcoin than most assets, and it freaks people out. But guys, be strong. Don't get shaken out over these, I'll say, little dips, because I've been in it for so long. I have held Bitcoin through every single bear market that Bitcoin has seen. And so for me, it's like so easy to hold through these dips. And I know that's not the case. If you're new into this space, it's stressful. And another thing I'll get into is I see a lot of podcasters and YouTubers, they say that bull markets are more stressful than the bear market. And I 100% agree with that. It's an exciting time. But if you think about it, excitement is really kind of a form of stress. But all of that, regardless of, excitement, just the bull market is so stressful because it's so exciting. You're watching it all the time, and any little move up or down is just this stressful thing. When it comes to the bear market, traditionally, I've seen it kind of turn into that bear market, and I'm like, forget it. I'm in it to win it. I'm going to hold. I'm just going to stop watching. So I stop watching for a year or so, and then it becomes interesting again, and I get all excited. Ooh, Bitcoin go up. And, but it's totally true. These up cycles are just so much more stressful than the down cycle for me, and for a lot of people that I keep hearing say that. So guys, you've got to learn some coping mechanisms in this market. You know, we're going up. We're going to continue to go up, but we're going to have these volatile bumps, and you've got to be able to manage your emotions during those times. So go get a hobby, get your eyes off of the market, the candles, the the price, go do something fun. Until next time, guys, I will be watching all of this closely for you and bring anything that I think you guys need to know to you. So please, if you wouldn't mind, like, subscribe, and share this with anybody you know that might find it interesting or helpful. And I will see you guys in the next video. Bye.